Okay, I think can start. Thank you all for joining in, and hello everyone. Welcome to the ninth edition of our Commodity in Focus webinar series. I'm your host, Hemant Bansal. A quick introduction about me. I'm based in India, and currently heading the Commodities Intelligence Solution at the Smart Cube. I've been in the commodity space for over more than 13 years now, and my responsibilities include working with clients to understand their requirements, challenges with respect to commodities intelligence, inflation, risk management, etc., and translate them into actionable custom solutions to meet their requirements. Joining me today are valued panelists, Anuj, Nishita, and Anirban. Each brings a wealth of knowledge and expertise to our discussion, and they will basically take us through a comprehensive, analysis of how global events are expected to shape up the commodities market in 2024. From an agenda standpoint, today's session is important as we talk about the three topics and their detailed impact on specific commodities group. First we will explore about global macroeconomic outlook, including inflation rates, interest rates, GDP, and their impact on metals. Second, we will discuss about the ongoing shipping issues that are happening around Panama Canal and the Red Sea route, and its impact specifically on freight rates, along with the risk on key commodity groups. And lastly, we will pick up a topic about China's economy, what experts are saying about its recovery prospects, China's significance in influencing crude oil and resins market outlook, specifically in 2024 context. And as we progress through, these topics, I'll encourage you all to, actively engage by posting your questions in the Q&A box to an extent possible, and not the chat box, please. Q&A box is basically you can find it at the bottom of your screen, and you can also upvote others' questions that resonate well with you. So, because we will also leave some time towards the end of the webinar session to answer all of these questions, whatever we can answer in the limited time we have. So, without any further delay, I think let's begin with our first agenda item, which is the global macroeconomic outlook. Anuj, over to you.
Thanks, Hemant. Starting with inflation, high inflation in 2022 and 2023 was influenced by a combination of energy price shock, supply chain disruptions, increased demand for durables, tight labor market conditions, and rising commodity prices. These factors collectively contributed to the significant rise in consumer prices during this period. Going forward, inflation is expected to decrease gradually. However, it will remain above the target range of central banks in the US and Eurozone. Central banks have taken measures to control inflation. The US is experiencing tight labor markets, which are expected to persist in 2024. This condition exerts upward pressure on wages and prices, contributing to elevated inflation levels. Strong domestic demand in the US economy is anticipated to limit the disinflation in service prices, leading to continuation of elevated inflation rates throughout the year. In Eurozone, uncertainty stemming from geopolitical tensions is a significant driver affecting economic activity in the Eurozone. Logistical disruptions in the Red Sea due to attacks on commercial vehicles by Houthi rebels and drought-related issues in Panama Canal poses upside risk to commodity prices as prolonged disruptions can eventually push up the freight rates. El Nino weather conditions also pose a risk to global food shortage and blackouts that can disrupt supply chains. In China, the inflation will increase gradually with government's push to stimulate the economic growth. On 15th January, the People Banks of China held its one-year medium-term lending rate at 2.5%, while injecting fresh liquidity into the financial system. However, the inflation may remain below the desired range. Now, moving on to the central bank's response to the inflation in the next slide. Central banks are expected to reduce interest rates at a slower pace from second half of 2024 due to concerns regarding the sticky inflation. As you can see from the chart on the left side, the policy rates in the US are expected to be around 4.5% and in Eurozone 4% by the end of 2024, well above the historical levels. In the chart on the right side, we have presented probabilities of target rates for different Fed's meeting. For example, for 12th June meeting, there is 57.4% probability of rate cut to 5.2% and 33.7% probability of no rate cut, that is Fed keeping the interest rate at 5.5%. Now, from this chart as well, it can be seen that the US Fed is not expected to cut interest rates in upcoming two meetings, that is in today's meeting and on 1st May. Now, these probabilities have shifted over the time, indicating a slower pace of rate cuts. Now, we will understand how the higher interest rates have impacted the manufacturing activities in major economies. Now, as you can see from the chart on the left side, that the PMI indicator for the US and Eurozone are in contractionary territory as higher interest rates have impacted the manufacturing activities in developed markets, whereas the emerging markets are driving growth with PMI being above 50 from 2023 onwards. In the chart on the right side, we highlighted that the outlook for 2024 was revised due to the various events. For example, for China, it was revised down by 0.6 percentage points, whereas for US, it was updated upward by 0.4 percentage points due to its higher than anticipated resilient economy. Let's take a look at the global economic outlook for 2024 in detail in the next slide. The global economic growth is likely to slow down in 2024 to 2.6% from 3% in 2023. In the US, the growth is projected to fall from 2.4% in 2023 to 2.1% in 2024 due to lagged impact of tight monetary and financial conditions. In the Eurozone, growth will likely remain stable in 2024 as economic activity is expected to pick up slowly, supported by a gradual recovery in consumer spending. Next, we will understand the impact of higher interest rates on the metal market. Now, as you can see from the chart on the left side, that the interest rates and LME inventories exhibit a negative correlation due to the impact of interest rates on cost of holding inventories. When the interest rates are high, the cost of storing in metal inventories increases, leading to lower inventory levels as it becomes more expensive to hold on to these assets. Now, in contrast, when the interest rates are low, the cost of storage decreasing, incentivizing higher inventory levels as it becomes more affordable to maintain stockpiles of metals. Now, interest rates also impact the US dollar index, which ultimately affects the metal prices. The US dollar index and metal prices typically exhibit an inverse relationship. As you can see on the chart on the right side, that the precious metal index has a strong correlation of negative 57% with the annual change in the US dollar index. So we can conclude that the monetary policy outcomes of major economies that impact interest rates and currency have a major impact on the metals market dynamic. Now, in the next slide, we will examine the economic scenarios based on the possible trajectory of inflation and policy outcomes. Now, our base case projection anticipate economic slowdown, a significant decline in inflation, and central banks in the US and Eurozone starts to rate cut from second half of 2024. In the base case, we anticipate the US dollar index to remain stable in the near term and to decline from second half of 2024. However, there is a risk that the banks might be cautious in their effort to bring down inflation to 2%. Now, in such a scenario, the central banks may maintain higher interest rates for a longer period. And this could lead to increased financial strains on households and higher rates of loan defaults. The pain in the commercial real estate sector could spread, which could further dampen the inflation. The downside risk associated with the higher energy prices could also increase inflation and deepen the recession, which could force US Fed and ECB to swiftly change its course later on. On the other hand, an optimistic scenario would involve Federal Reserve and ECB adopting a more relaxed approach to inflation and quickly returning to the neutral interest rate setting. Now, this would allow corporations and CRE to refinance at much lower rates, keeping loan losses minimal. Additionally, strong productivity growth and an increase in labor supply from immigration would help keep inflation under control. The expected scenario for China involves the continuation of the ongoing deleveraging efforts. Now, the focus here is more on aligning the property sector with the President Xi's common prosperity theme rather than encouraging investment. So, this approach implies that the sectors that are typically linked to the property development or construction industry, such as steel, glass, and cement, will continue to face challenges. While the local government finances have improved due to debt restructuring, significant constraints remain, limiting a significant increase in infrastructure spending to compensate. Now, weak global demand and an ongoing US sanctions further restrict the external sector's ability to offset these challenges. Now, next we will provide you the outlook for the metal prices based on these three scenarios. The prices for the base metals except aluminium are expected to decline in 2024. The global aluminium market will likely witness a deficit of 0.7 million tons, accounting for 1% of global aluminium production in 2024, as the growth in consumption will outweigh the rise in production. The global aluminium production may increase by 2.3% on annual basis in 2024 as compared with a 5.7% surge in the global aluminium consumption. Whereas for copper, we expect prices to remain bearish in 2024 as the global copper market is expected to remain in surplus of 467,000 tons, accounting for 2% of the global refined production, as the growth in production is likely to outweigh the rise in consumption. The global refined production is projected to increase to around 27.5 million tons on account of expected increase in copper output amid new capacities in DRC, Peru, and Chile. whereas the copper consumption is likely to increase to 27 million tons, driven by a rise in demand from the renewable energy and electric vehicle segment. Zinc and nickel markets are also expected to witness surplus, exerting downward pressure on prices. The nickel market is likely to register a surplus of 151,000 tons in 2024 due to increase in production from Indonesia, whereas the zinc market is expected to be in surplus of 367,000 tons, accounting for 2.6% of the global production. Now, moving on to the precious metals, the gold prices are expected to increase by around 5% in 2024 due to anticipated interest rate cuts by the US Fed from second half of 2024, leading to a drop in US dollar index. Further, the gold consumption may increase 2% on annual basis in 2024, driven by an expected rebound in demand from the jewelry segment. Whereas platinum prices are expected to increase marginally in 2024 as the platinum market will be in a deficit of 418,000 ounces, whereas the palladium prices are expected to continue to drop in 2024, driven by a slowdown in demand from the downstream automotive sector amid continued shift towards the electric vehicle and increasing substitution of palladium with platinum. The deficit in the palladium market is expected to decline to 105,000 ounces in 2024 versus a deficit of 600,000 ounces witnessed in the year 2023. Now, moving on, my colleague Nishita will be taking you through the shipping issues prevailing in the global market in detail. Over to you, Nishita.
Thanks, Anuj. So, the next event, which is straining the global supply chain, are the ongoing disruptions in the shipping industry. For the first time, the world faces simultaneous disruption in two major global trade lanes, the Panama Canal and the Red Sea. Let's see what exactly happened on these shipping routes and what significance they hold in the global maritime. Starting with the Panama Canal. So, this route plays a vital role and accounts for almost 5% of the global trade and 9% of global container traffic. Issues began in 2023 as Panama is suffering the worst drought since 1950s, partially due to the impact of the El Nino weather pattern. The drought has reduced the water levels in the Gatun Lake, which holds the water supply that operates the Panama Canal. Now, in response to dropping water levels, the Panama Canal Authority began to restrict the daily number of ship transits, which dropped from a daily average of 36 transits to 22 in October 2023. The unreliability of transit through the Panama Canal prompted some ships to reroute. This has added to the shipping problems as new routes have increased the transit time. Take, for example, a ship traveling from Shanghai to New York will take 36% longer time via the Cape of Good Hope than going via the Panama Canal. Now, as the world was adjusting to the Panama Canal restrictions, it stumbled upon another issue at one of the most important choke points, that is the Suez Canal, due to the disruptions in the Red Sea. To give you a bit of a context here, 15% of global trade and 34% of global container traffic transits via this strategic waterway, establishing it as the fastest route between Europe and Asia. However, access to this significant waterway has been impacted for several months as a result of the ongoing conflict in the Middle East. This crisis began in October 2023 when Houthi rebels in Yemen began attacking container ships in the Red Sea in response to the Israel-Hamas war. Because of this increased threat, several of the world's largest shipping carriers, including MSC, CMA CGM, Maersk, etc., have announced to reroute all Europe-bound vessels via the Cape of Good Hope. As a result of this, the voyage time between Asia and Europe has become 30% longer versus the Suez Canal. As a result of the diversion away from the Panama and the Suez Canal, the effective shipping capacity is reducing, which means that now more ships are needed to do the same trips back and forth, leading to more stress on the global supply chain. On the next slide, we have the monthly vessel transits. On the chart, we have plotted the total number of ships, which includes the cargo and the tankers, passing via three choke points: the Suez Canal, the Panama Canal, and the Cape of Good Hope. In both the Suez and the Panama Canal, transits are down by 52% and 35% compared to the October 2023 levels, respectively. One point to observe here is that most of the decline in the Suez Canal occurred since the fourth quarter of 2023, while the transits through the Panama Canal have been decreasing from early 2023 due to the weather-related disruptions. On the other hand, an alternative route, notably around the Cape of Good Hope, is experiencing a surge in the vessel tonnage passing through it. According to IMF PortWatch data, in February 2024, the number of transits were 53% above the October 2023 levels, which is the highest since 2019. Next, let's move and see how the ocean freight rates have been impacted due to the ongoing logistical disruptions. So, during 2020 and 2021, COVID-19's effect drove the container freight rates to historic highs as ports around the world suffered worker shortages, public health restrictions, and supply chain bottlenecks. However, after a golden time for the shipping industry, we saw a progressive weakening of freight rates throughout 2023 as congestion eased and global economic growth slowed down. Since late 2023, the Red Sea crisis pushed up the global container freight rates again. For the US, the combination with the Panama Canal's low water restriction further complicated the supply lines, especially to the East Coast. In February 2024, the global freight rate for a 40 feet equivalent unit witnessed a 185% jump versus November 2023 levels. What is equally important to notice is that the impact on freight rates has also varied across different routes. As you can see on the graph on the right, prices along the routes that typically go through the Suez Canal, particularly from Asia to Europe or Asia to Mediterranean, have jumped 270% since November 2023. On the other hand, rates from Asia to the US West Coast and East Coast have saw a significant spike of 117% and 130% respectively when compared to November 2023. While the largest impact so far has been along the Asia-Europe shipping lanes, cost along the other routes could also increase as capacity gets redirected. Moving on, after understanding the current movement of the freight rates, An important question which comes to our mind is how we expect the freight rates to trend for the rest of the year. Now, after witnessing a sharp increase in the last 2 to 3 months, we expect the rates will continue an uptrend till the second quarter of 2024 before dropping during the second half of this year. Our base scenario is based on the assumption that the shipping issues at both the Red Sea and the Panama Canal will end in the next 3 to 6 months. Continued efforts to broker a truce between Israel and Hamas are ongoing, and expectations are for a possible ceasefire in next 3 to 6 months. Similarly, as the El Nino weather pattern is now fading, which means the rainy season should hit in late April or May, allowing the Panama Canal to ease the shipping limits. Therefore, in 2024, the freight rate is expected to increase around 45 to 50% in 2024 versus the average levels that were seen in 2023. Now, the key factors which will be influencing the freight rate in 2024 will include the ongoing geopolitical tensions like the conflicts and the political instabilities in Ukraine and Israel, which are disrupting the trade routes and could raise the insurance cost, impacting the freight rates. This is expected to keep the rates elevated during the first half of 2024. Also, port congestions, while may have eased compared to the peak of the pandemic, it can still cause delays and disruptions impacting the cost and influencing the rates. Now, coming to demand, according to Clarkson's forecast, the global container cargo volume for 2024 will increase around 3.7% versus last year. This upward trend is primarily associated with the end of interest rate hikes in the US, which will result in the recovery of consumer and corporate demand. From the supply side, shipping capacity will be a factor to watch out for. The supply chain issues of 2021 and 2022 led to a surge in new ship orders, which are now entering the market and creating an oversupply of shipping capacity. As of the end of 2023, the global container ship capacity reached 27.8 million TEUs, which is a rise of 8.3% compared to 2022 and also the highest growth rate in the past decade. It is anticipated that by 2024, the container ship capacity will see another 7.1% increase. The delivery of a large number of container ships may lead to an intensified competition and pressure the freight rates to drop during the second half of 2024 due to oversupply. Now, given the volatility in the market, we at the Smart Cube used scenario modeling assessment to gauge the impact on freight rates in an optimistic as well as a pessimistic scenario. Earlier than expected resumption of the trade routes will push the freight rates lower and closer to our optimistic case depicted by the light green line on the chart. And on the other hand, a prolonged halt in these transits until the end of 2024 will be a major jolt to the market and will push the prices up to our pessimistic or the worst case forecast. The increase in freight rates in 2024 could also prove inflationary for commodities. Prolonged trade disruptions, longer lead times, and increased costs could pose an upside risk to few commodity groups. On the next slide, we discuss this in more detail. First up are the concerns about the disruptions to global oil markets, as approximately 12% of global seaborne oil trade passes through the Red Sea, making it a critical route for crude oil and refined products. Since Russia-Ukraine war, there has been an increase of oil flows towards Asia as a result of the European Union's ban on imports of Russian oil, which has seen Russia shipping to alternative destinations, particularly India and China. The current situation is leading to a growing number of tankers being diverted. However, till now, there has not been any significant drop in the oil availability. A bigger risk for the oil market is if the situation spreads, leading to disruption of the oil flows going through the Strait of Hormuz, which accounts for 20% of global oil consumption. Coming to gas, LNG flows through the Red Sea also constitute 8% of global LNG trade. As US LNG export capacity grows, more LNG is being redirected through the Red Sea, particularly towards Asia. Qatar, which is the largest supplier of LNG to Europe, sends significant portion of its LNG through the Red Sea and the Suez Canal. If the situation in the Red Sea deteriorates, LNG flows may experience disruptions and longer shipping time. For some of the metals, as my colleague Anuj discussed, we are expecting a drop in the prices in 2024. However, prolonged conflict in the Red Sea will be a potential risk to watch out for. Europe, for example, relies heavily on aluminium imports. Also, the shipping disruptions come at a time when the Western European aluminium production is at the lowest this century. Any major disruptions could push up the prices. Similarly, China and other Asian countries are also critical minor metal exporters to Western countries. European and US buyers are grappling with delayed Asian shipments of minor metals like manganese, magnesium, silicon, antimony, etc., which are used in batteries and semiconductors owing to the disruption on the Red Sea route. Finally, for agricultural commodities, grain cargoes are also being diverted due to the conflict. Wheat shipments via the Suez Canal fell about 40% in the first half of January. There have been delays in coffee shipments to Europe, not only from Vietnam, but also some of the key suppliers like Indonesia and India. The drought hit Panama Canal's transit limits and high fees are driving US grain exporters into longer routes with higher freights. If the restrictions continue, this will impede the grain shipments well into 2024. Now, having discussed the shipping issues and their potential impact, we will now move on to see how the Chinese economic growth will impact oil and resin prices. So, over to you, Anirban.
Thank you, Nishita. So now we'll be discussing how the Chinese economy performed in 2023 and what are the projections we have in store for 2024. Now, a quick glance at some of the key indicators of economic health show that the Chinese economy experienced ups and downs in 2023. However, the economy started off 2024 on a strong footing, with several key indicators beating market expectations during the first 2 months of this year. This offers an encouraging sign that the world's second largest economy is not only consolidating the recovery momentum, but it is also picking up pace. Now, the industrial output grew 7% year on year in the first 2 months of this year, which is well above the 5% forecast predicted by Reuters poll. It is also the fastest growth since March 2023. Moreover, the China manufacturing PMI came in at 50.9 in February, remaining in expansionary territory for the fourth consecutive month. During January and February, retail sales expanded 5.5% from the same period last year versus a Reuters poll forecast of 5.2%. During the day Spring Festival holidays in February, nationwide domestic tourism that reached around 474 million trips, which is an increase of 19% when we compare with the same period pre-COVID, that is 2019. While total expenditure amounted to around 632 billion yuan, which is up 7.7% again from the same holiday period in 2019. So we can well say that the spending boost will likely prevail throughout the year, and as more stimulus policies take effect, and the after effect of the pandemic continues to diminish. Now, moving on to the next slide, we'll see how the Chinese GDP performed last year. So one may say that it's mission accomplished for China in 2023, as data for the past year confirms that the Chinese economy achieved its 2023 GDP growth target. So the economy grew around 5.2% year on year, which is in 2023, which is slightly more than the official target that was set at the last year's two sessions meet, and the target was set at 5%. So now, as evident from the chart, the growth was slightly lower than the past 5-year average. Now, moving on to the outlook for 2024, analysts are predicting that the China's GDP growth it is likely to moderate at around 4.6% year on year this year. And in this year's two sessions meet, China has announced an ambitious growth target of around 5%, promising steps to transform the country's development model and diffuse risks which are being fueled by bankrupt property developers and indebted cities. In our opinion, we believe that there will be three key elements that could hold the balance of risks for growth for China going forward. So first would be the real estate sector or the property sector. So in the first 2 weeks of the year, housing sales were at roughly half of last year's level, which is a poor start. So households are still not confident that developers, given the financial difficulties, they could deliver completed housing units. Now there are several programs which are being rolled out to support the property sector. So in late 2023, the government proposed to expand major urbanization projects, including the redevelopment of the so-called urban villages. Now it appears that the proposal will go ahead given the high priority of stemming the property downturn. For example, the People's Bank of China has already identified a major policy tool that may be used for financing. And once it is fully rolled out, the urban renewal project could translate into up to 10% of annual sales. Now, coming to the second key driver, and that would be exports. So, emerging sectors like electric vehicles, they have expanded quickly and are becoming a driver of overseas exports. So the rapid growth of this EV exports and overall expansion in manufacturing capacity that provided support to the economy during the housing downturn. But on the flip side, we'll have to keep in mind that the surge in exports and growing attention to issues of overcapacity is beginning to spark pushbacks in global capitals. So trade tensions could result, and that might lead to renewed pressure on China's exports and manufacturing industries. Now, coming to the third key element, and that would be sentiment. So, given that has been an increase in regulations over the last few years, private sector investment that has slowed down a bit. So, while there is a cyclical element to it, but government policies also matter for confidence in the corporate sector. So, in 2023, policymakers they delivered a modest amount of monetary and fiscal easing. We expect that this monetary policy easing would continue in 2024 and could quicken if the US eases monetary policy, which is being expected by markets. Now, fiscal policies may also help in stabilizing the housing market, and so a less turbulent housing market combined with more regulatory clarity that could hold the key to a more lasting positive economic outlook. In our view, if China performs well in all of these parameters, then in an optimistic scenario, Chinese GDP growth may reach 5.2%, exceeding the state target of 5%. However, if it falters in any of these key drivers, then it may go down to 3.8% as well. Now, moving on, we would now like to discuss how important China is as a player in the global oil and resins market. So, as you can see the chart on the left hand side, shows the top 5 oil consuming countries, and China is the second largest oil consumer globally, which and the country accounts for roughly 15% of global demand. Moreover, it is also the largest oil importer globally, and it accounted for around 20 to 25% of global oil imports during 2018 to 2022. And as we can see here, that China will continue to be the second largest consumer and maintain its dominant position in the global oil market going forward in 2024 as well. Similarly, the chart on the right hand side, it shows that the APAC region accounted for roughly 40% of the plastic resins market globally in 2022, and China was the major contributor in it as well. So large scale production of finished plastic goods and also a rapid increase in downstream processing capacity, they are the major drivers of plastic consumption in China. Hence, how the economy of China shapes up in 2024, that will play a dominant role and drive demand and prices of these commodities. Now, in the next slide, I would like to take you through the Brent price outlook. Before that, a quick backdrop of what happened in 2023. So, crude oil prices in 2023, they declined, and that was predominantly driven by weak demand sentiment, continued interest rate hikes by major central banks, and further, slower than expected economic recovery in China led to lower oil demand from the country. And this all of these factors combined brought down crude oil prices in the past year. At the same time, there was also higher than expected supply from some non-OPEC producers, especially from the US. However, to counter this fall in prices, the OPEC plus cartel, they came up with some production guidance for the year. Like in April last year, the cartel announced voluntary production cuts of around 1.7 million barrels per day from May till December. In addition to this, Saudi Arabia and Russia, which are two of the largest oil producers, they also announced additional voluntary supply cuts. Hence, prices picked up in the third quarter of 2024, which we can see from the graph as well. Now, quickly moving on to the outlook, going forward, we expect prices to inch up this year, and that will be likely driven by a rise in global oil demand, heightened geopolitical risks, and expectation of supply tightness in the market, which may be caused by the extension of OPEC plus output cuts. Global oil demand is projected to grow around 1.4% year on year in 2024, reaching around 102.4 million barrels per day. Further, the likelihood of expansionary measures by China to revive its economy may support oil demand from the country. So China's oil demand is expected to rise 2.1% year on year, reaching 16.3 million barrels per day, which is higher than pre-COVID levels. Also, the ongoing production cuts and likely extension going forward will aid the price uptrend. And as we have already seen, the persistent geopolitical tensions, which have been continuing because of the Russia-Ukraine conflict and the Israel-Hamas conflicts, they will also remain a potential threat to oil supply in 2024. However, some challenges may be posed by higher interest rates and persistent inflationary pressure, which may restrict the price rise. So in a base scenario wherein we expect the Chinese GDP to grow around 4.6% year on year, we project Brent prices to average around $83 per barrel. However, stronger growth in the Chinese economy may push up oil demand in the global market, and in this case, prices may reach around $90 to $92 per barrel. While on the contrary, if China's economy does not meet its median of 4.6% growth, then prices may drop to the mid 70s dollars per barrel. Now, moving on to resins. So in 2023, we saw a price drop across all resin grades, and that was primarily due to weak demand. So global demand remained subdued amid elevated inflation levels, and that led to muted end-use consumption of plastic products. Sluggish recovery in the Chinese demand was also a primary factor that aided the price fall. Additionally, capacity additions across all regions led to improved supply globally. Now, what or how will resin prices pan out in 2024? So, polyethylene and polypropylene prices are likely to recover this year, and that will be driven by the introduction of stimulus packages by the Chinese government and favorable real estate policies. They are likely to support economic growth in China, and that might be a major driver of global resins demand. Moreover, as per the IMF, global inflation is anticipated to drop to around 5.2% year on year in 2024, which is down from 6.8% year on year seen in 2023. So this drop in inflation level would also support consumer confidence, and that might also push up resin buying. Apart from these ongoing trade flow disruptions across major shipping routes, that may positively impact P and PP prices in Europe and Asia, as they are net importers of these resins. But in the pet market, we may see some downward revision in prices amid extensive capacity additions, which may likely outweigh the impact of demand growth. So, around 7.2% of global pet capacity is expected to restart or rather commence operations in 2024 in China. Lastly, we would like to emphasize that the performance of the Chinese economy will be a key determinant of oil and resin demand as well as prices. So, if we see the Chinese economy to show strong improvement in 2024, then that will push up prices more than our base scenario and vice versa. So, that's it from my side on this topic. Over to you, Hemant.
Thanks, Anirban, and thanks, Nishita and Anuj, for taking us through quite powerful insights. And with this, we have come to the end of today's webinar. But before we do that, we will open the floor for Q&As, and I think there are a couple of questions that have come. So let me just pick one by one. So I think this is for you, Anuj. Copper prices have increased beyond $4 per LB, recently. Do you think that prices will remain above this threshold for rest of the 2024?
Yes, so the copper prices have surged recently due to production cuts by this Chinese smelter. They have announced production cuts due to decrease in the ore processing fees, right? And the TCRC charges for the copper have declined to around $11 per ton, plummeting around 75% in just 2 months, and they have reached to the lowest level since 2023 due to shortage of copper concentrate. However, we expect prices to see correction in the near term, and they might decline due to persistent oversupply of refined copper globally. And additionally, we expect around 1.7 million tons of new smelter projects to commence operation in second half of 2024 outside China, which will again exert downward pressure on prices. And as
Okay.
per our base case scenario, we project prices to be at around $3.8 per pound or around $8,500 per tons for the 2024 average.
Okay. Great. The next question is again for you. Do you have the price outlook for other metals, or can you comment on the outlook for other metals like lithium and titanium ingot?
Uh, yeah, sure. So for lithium, we are expecting a double-digit drop in percentage for 2024 due to anticipated surplus in the market due to new capacities that are coming up in Argentina and Australia. Whereas for titanium ingot, we expect prices to increase in 2024, due to continued rise in demand from the downstream aerospace industry.
Okay. The next question is basically asked by Akshata Nayak. So, ocean freight rates expected to grow by how much percentage in 2024? Growth rate of 2024 freight rates. I think this we have already covered, Akshata Nayak, hopefully in the webinar, and you got your answer. So, we'll get to the next one. Marty has asked, are the freight rate slides specific to ocean freight or all freight modes? So the slides were basically specific to ocean freight rates, Marty. Nishita, this is, I think you will need to jump in here. The next question is, do you think that introduction of the Gemini Corporation will help resolve some issues which shipping industry currently faces?
Sure, Hemant. So, Gemini Corporation, it's basically an operational collaboration which has been announced between the Hapag-Lloyd and Maersk, and it will come into operation from next year, I think from February 2025. And the objective of this alliance is to improve, the schedule reliability and accelerate also the decarbonization process, which is there in the shipping industry at this point. So definitely, if it is effectively implemented, this will help to address, industry's challenges of especially the global supply demand imbalances, which kind of impacts the earnings for the shipping companies. But at the same time, it will also bring some cost efficiencies for carriers, shippers, and for consumers, it will improve the service quality as well. So if it is implemented, as per expectations, definitely it can help to resolve some of the issues we are currently facing.
Okay. I think the next was also a very interesting question. East Coast and Gulf Coast port worker labor contracts will end in September 2024. Do you think this could be a risk for freights to the US?
So, yes, it would be definitely a important factor to watch out for, especially, towards the latter half of the year. And in fact, what is coming is that even the cargo owners have been advised, to make some contingency plans for a possible strike at the US East and the Gulf Coast post, right? But because these contracts will end in September and October, from the October, it's also the peak shipping season to the US. But historically speaking, the ILA has had a likely less probability to go on a strike as compared to their Western Coast Union counterparts, as the last strike they had was in 1977. But while the probability would be relatively low, but definitely it's one of the risks that will be there to watch out for.
Okay, great. The next question is for you, Anuj. Do you see gold prices increasing to $2,300 by the end of 2024?
Uh, so our base case projection for the gold is to be average around 2150 per ounce in 2024, and prices may peak around 2250. Whereas in optimistic scenario, we do expect gold prices to reach around $2,300 per ounce by end of 2024 if the central banks opt for a sharper than anticipated rate cuts. However, in 2025, we expect gold prices to trade above 2200 mark under the base case scenario.
Great. Okay. So just a gentle reminder, everyone, we still have like a couple of minutes. If you have any more questions, please post in the Q&A box before we finally end the webinar session. So we still have like 3 questions left, but encourage you all, if you have any more questions, please post it. So the next question is for Nishita. Any insights, not just an ocean freight, but for cold chain ocean and cold chain air freight forecasts?
So, Hemant, currently we do see that freight rates both for ocean and air, they are seeing the increase because of the disruptions that we are seeing at the key routes, and more cargoes are now being diverted. They're trying to move to air freight, but definitely it is more expensive. So we are also seeing some increase on the air freight routes as well. But to go more into detail, we can look into it and take that in detail later.
Great. I think freight is a hot topic. I think again the next question is for you. Did your analysis, and this question has been asked by Richard. Did your analysis on shipping rate increase take into consideration that Far East or Middle East sourcing versus US or Europe sourcing could be swapped and thus reduce transport capacity needs?
So yes, we did take into account that these swaps can happen, but any changes like these need certain time to take place, right? So there will always be a lag when these sourcing changes can take place, and that's why after expecting a rise in the first half of this year, we are expecting that market situation does make certain changes, and the freight rates will come down towards the second half of the year.
Perfect. Okay. Uh, Next question is for you, Anirban. Chinese economic growth is expected to moderate in 2024. Why do you still predict polyethylene and polypropylene prices to go up in 2024?
Okay, yes, Chinese economy is expected to moderate. There would be kind of stable demand from China, but given the fact that China is implementing expansionary monetary and fiscal policies, so it is expected that the economy would revive in the second half of this year, and that might push up global tea demand. Apart from that, there are a couple of other factors that we need to keep in mind. One is that uh, the inventory across PE and PP supply chain is lean. Since the global market has did not witness much demand over the past 2 years, hence buyers and producers, they were pretty uncertain about the demand outlook, and they had maintained very lean inventory. So any disruption to supply would push up prices. Like we have been seeing recently that trade flow through the Red Sea area to Europe has been impacted, and that has suddenly led to panic amongst buyers, and they have actually resorted to restocking, which has pushed up prices in Europe. So those risks are there in the market. Additionally, to add quickly that inflation is has come down from the elevated levels in 2023, and that will also support buying sentiment going forward. So
Okay.
all these factors combined will push up P and PP prices in 2024.
Okay, I think there's one more question from Prabhat. Do you have a MI report or any further details on the deflationary situation in China? So, yes, Prabhat, I think uh, we do have like lot more details, and we can go even in depth details of in your requirements. So maybe you can write it to me, reach out to me on hemant.bansal@wns.com, and we can connect there and take down your requirements, what kind of further details you are looking forward to. Uh, uh, then yes, just the last question I think we have is, if we look at the Brent chart, we see that prices have dipped in Q4, quarter four of 2023, when the Red Sea crisis started to pick up. And prices have not picked up much this year as well. So why is that so? And are any trade flow disruptions not having any impact on oil prices?
So, yes, we did see some geopolitical risk emerging towards the end of the year with the, Israel-Hamas war coming into the picture, as well as attacks on commercial vehicles. However, these concerns eased since there has not been any direct impact on Middle Eastern oil supply so far. So that has led to a decline in prices towards the end of the year. Also, commercial vessels, they are getting delayed due to the longer route that they now have to take through the Cape of Good Hope. But even since demand has not picked up much, so even with the delay, the shipping delays and everything, they are still able to cater to the existing demand in the market. So that is the reason why we haven't seen a major uptick in prices till now. But yes, if this crisis gets prolonged and somehow it kind of expands and impacts maybe Iranian supply or the Strait of Hormuz, through which around 20% of trade happens daily. So then we'll definitely see a major impact on
Okay.
Brent prices.
Perfect. Thanks, Anirban. And I think with this, we have no more questions, but happy to answer any more questions. I know we are 4 minutes over time, but if last minute, if you have any questions, please post it. Otherwise, we are good to go. Yeah. Okay. Then no more questions. Then thank you everyone once again for joining in and making this webinar a successful one. Thank you so much and have a good rest of the day.